Yeah, I think we are in a very fascinating point in the cycle, because we've seen one of the strongest accelerations that we've seen at any point over the last 20 years, powering up the equity market. European equities up 70%, and we think the global growth cycle has just peaked. And there's a second element that is going on. We've seen a collapse in the discount rate and real bond yields. And that really was a Goldilocks environment for equity. Stronger growth, a lower discount rate. You really couldn't hope for anything better. But we think both of these trends are now coming to an end. We think growth will start to roll over, growth momentum will start to weaken, and the discount rate will come up as central banks start to withdraw monetary accommodation. So we think right now we're going from Goldilocks to anti-Goldilocks, and that effectively means the end of the recovery rally.
So Sebastian, does that mean that you are turning more bearish on cyclical plays?
We are, effectively. We've been overweight cyclical to everything that has any kind of cyclicality over the past year. And we've now started to reduce our exposure. We've turned neutral on equities from positive. We've turned neutral on cyclicals versus defensives from positive. And for the first time in a year, we've got cyclical underweights in our portfolio, mining and luxury goods. And for the first time in a year also, we've got a defensive overweight, which is personal and household goods. That's the like of Unilever, Henkel, Reckitt Benckiser, and so on. So we are in full swing, effectively, away from the cyclical plays towards preparing for a slowdown in the global economy.
What I find quite interesting, Sebastian, about what you've laid out with your thesis, and thank you for spelling it out for us very clearly, is you somehow are still overweight the periphery indices, and those have obviously been very high beta indices as a function of the recovery. Why is that the case today?
Yeah, I think that's a great question. And therefore, I was saying we are not yet fully defensive. We're in the process of moving towards that kind of defensive positioning. And for each of these plays, we have to understand what are the main drivers. And the peripheral trades, as you highlight, we're still overweight. That's Spain, that's Italy. And they're simply very linked into the banks trade. So you can really think of these country performances for the periphery as largely driven by what happens to financials. And that's the kind of complexity and the slightly more difficult character of the current peak in the cycle. Because yes, growth momentum is slowing, but bond yields are already very low. As you know, it's been the biggest story in markets, the pullback in bond yields. So we think they have undershot their relationship with growth momentum. And plus, if central banks start to move towards tighter monetary policy, that should help to lift real bond yields and hence nominal bond yields. And financials obviously love higher bond yields. And so therefore, we've reduced a lot of our cyclical exposure, with the exception of the yield-sensitive plays, because they should benefit from this kind of yield dynamic we've just discussed.
I guess, we all fall into the mistake, or not a mistake, but just out of habit of placing all value stocks into the same basket. But you've got to distinguish between financials, which is what you're doing in this case, versus, say, the likes of oil and energy stocks. And just to go into that particular theme a little bit more, I also have noticed that you've removed UK index, the FTSE, from overweight to market weight. Is that, again, tying into your hypothesis that growth is going to moderate and that some of these value stocks, in particular in oil and energy space, have run their course?
Yeah, I think that's very well observed. And it comes back to the theme that I highlighted earlier. We really have to go trade by trade and understand what are the macro factors that they are sensitive to. And so for the financials and therefore for the periphery, it's really these yield dynamics. And therefore you have to ask yourself, if real bond yields are at an all-time low and central banks start moving away from easy monetary policy, what does that mean? And we've discussed that. For energy, on the other hand, and by extension for the UK, because the UK is very sensitive to what happens to the energy sector, the real question is what happens to the commodity complex. And that is very sensitive to the dollar. And we effectively think, after a tremendous fall in the dollar over the past year, that now as growth slows, macro uncertainty comes up. Whenever that happens, the dollar tends to strengthen. And so therefore we see no further upside for commodities. Therefore we've turned underweight mining. We've neutralized our overweight on energy, as you correctly say. And that makes it harder to be positive on the UK.